the most powerful banker in America, just looked a room full of investors dead in the eye and told them that his competitors, the people who hold your mortgage, your car loan, your credit card debt, are doing dumb things, and those are his exact words, not mine, because Jamie Dimon, the man who has run JPMorgan Chase through every single financial crisis of the last 2 decades, just warned that he's seeing parallels to the era before the 2008 financial crisis. And if that sentence doesn't make the hair on the back of your neck stand up, then you weren't paying attention in 2008 when trillions of dollars in household wealth evaporated in a matter of months. JP Morgan's own stock dropped 4.21%, falling from $310.76 to $297.67. Because when Jamie Dimon tells you he sees ghosts of 2008, the market listens, even if you don't. And here's what's terrifying about this. It's not some random analyst on social media making bold predictions for clicks. This is the CEO of the largest bank in the United States, a man who personally orchestrated the emergency acquisition of Bear Stearns when it collapsed in 2008, a man who watched Lehman Brothers die from across the street, a man who has seen what happens when banks get reckless and credit standards fall apart, and he just told you publicly, on the record, that he's seeing it happen again. This is not a drill, this is not speculation, this is not me reading too much into a quarterly earnings call. This is Jamie Dimon drawing a direct line between what's happening right now in the financial industry and what happened in the years leading up to the worst financial disaster since the Great Depression. Now, so let's talk about what he actually said, because the details matter here, and the mainstream financial media has already started softening his words, packaging them into neat little headlines that strip away the urgency. And I'm not going to let that happen, because what Dimon said at this investor event on February 23rd was far more alarming than most people realize. He was asked about the fierce competition happening across the financial industry right now, and instead of giving some corporate non-answer about maintaining discipline and focusing on shareholder value, which is what every other CEO does when they get that question, Dimon went straight to the jugular. He said he's starting to see parallels to the era before the 2008 financial crisis, when a rush to make loans ended disastrously, and then he added the line that should be tattooed on the forehead of every bank regulator in America. He said his rivals are doing dumb things. Now I want you to really think about what it takes for a man in Jamie Dimon's position to say something like that publicly, because he is not some loose cannon who shoots from the hip. This is one of the most calculated, most media-savvy executives in the history of American finance. And every single word that comes out of his mouth at an investor event has been weighed and measured and pressure-tested by an army of lawyers and communications professionals. And he still chose to stand up and say that banks are doing dumb things, that the competitive environment in lending has gotten so reckless that it reminds him of the period that produced the worst financial crisis in modern history. When Jamie Dimon uses the word dumb to describe what his competitors are doing, that's not casual conversation. That's a warning siren, because this is a man who makes his living by being more disciplined than everyone else, by being the last one standing when the music stops. And he's telling you right now that he can hear the music starting to skip. He also talked about navigating the era of artificial intelligence during this same event. And we're going to get into that because it connects directly to the lending problem in ways that nobody is discussing. But first, I need you to understand the full weight of what it means when the biggest banker in America starts talking about 2008, because the people who dismissed those warnings last time lost everything. Let me explain why the phrase dumb things is actually the most terrifying combination of words that can come out of a bank CEO's mouth. Because in banking, Dumb things has a very specific meaning, and it's not about making bad stock picks or hiring the wrong people. It's about loosening credit standards to win market share, and that is the one thing that has preceded every single major financial crisis in the last 100 years without exception. Here's how it works, and this is the mechanism that nobody on financial television is going to explain to you because it makes their advertisers look bad. When competition for loans is fierce, banks start looking for ways to win deals, and the first thing that gets sacrificed is always credit quality. Always. Because loosening your underwriting standards doesn't show up on the quarterly earnings report. It actually makes the numbers look better in the short term because you're booking more loans and generating more revenue, and the losses from those bad loans won't show up for 2, 3, sometimes 4 years down the road, by which time the CEO who made those decisions has already collected his bonus and moved on to his next job. This is exactly what happened in 2004, 2005, 2006, and 2007. Banks were competing so aggressively for mortgage origination volume that they started approving loans for people who had no income, no job, no assets, and they literally called them ninja loans. And at the time, every bank CEO who was asked about it said the same thing. They said the risk is manageable, we have sophisticated models, our underwriting is sound, and every single one of them was either lying or delusional or both. The way it starts is always the same, and I need you to understand this pattern, because if you understand the pattern, you can see what's coming before it hits. Bank A loosens its credit standards slightly to win a big loan from a corporate borrower. Bank B sees that it lost the deal and loosens its standards to match. Bank C sees that both of its competitors are now offering easier terms and loosens its standards even further to win back market share. And within 12 to 18 months, you have an entire industry that has abandoned prudent lending in a race to the bottom, that everyone knows is insane but nobody can stop, because if you don't play the game, you lose revenue, and your stock price falls, and your board replaces you with someone who will play the game. This is what Dimon is describing when he says rivals are doing dumb things. He's watching this exact dynamic play out in real time. He's watching banks loosen credit standards and take on risks that they shouldn't be taking, and he's doing the one thing that a sitting bank CEO almost never does. He's saying it out loud, and the fact that he feels the need to say it out loud should terrify you, because it means the problem has gotten bad enough that he can't just sit there and watch anymore. And I want you to notice something really important here. Dimon isn't saying JPMorgan is immune. He's saying JPMorgan is maintaining conservative lending practices, which sounds like a good thing until you realize what it actually means. It means they're losing deals. They're watching their competitors win business by offering terms that JPMorgan's risk team won't approve. And Dimon has to go to his shareholders and explain why JPMorgan's loan growth is slower than the competition. And his explanation is essentially, we're not doing the dumb things that everyone else is doing, which is exactly what he said in 2006 and 2007, right before the entire system collapsed, and JPMorgan was the last one standing. So let's go back to 2008, because if Dimon is drawing this parallel himself, then we need to understand exactly what happened last time and exactly how it played out, because the parallels are more specific and more frightening than most people realize. In the years leading up to 2008, the American banking system went through a transformation that happened so gradually that most people didn't notice it until it was too late. Starting around 2003, as interest rates were low and competition for mortgage volume was intense, banks began systematically dismantling their own underwriting standards, and they did it for the same reason that Dimon says his competitors are doing dumb things today. They did it because the pressure to grow revenue and maintain market share was so overwhelming that the short-term incentive to book loans crushed the long-term incentive to make sure those loans would actually get paid back. First, it was the documentation requirements. Banks went from requiring full documentation of income and assets to what they called stated income loans, where borrowers could essentially write down whatever number they wanted and the bank would accept it. And then they went even further to no-doc loans, where they didn't even pretend to verify anything. And each step down this ladder felt small and incremental and manageable, until you stepped back and realized that the entire industry was lending hundreds of billions of dollars to people whose ability to repay had never been verified by anyone. Then it was the loan-to-value ratios, where banks went from requiring 20% down payments to 10%, to 5%, to 0%. And in some cases they were actually lending more than the home was worth through second lien products. So the borrower had negative equity from day one, meaning the very first monthly payment they made was on a property that was already underwater. And then the securitization machine took over. And this is the part that turned a bad lending problem into a global financial apocalypse, because the banks discovered that they didn't have to hold these terrible loans on their own books. They could package them into mortgage-backed securities and sell them to investors all over the world, and the rating agencies would stamp AAA on these packages of garbage because they were being paid by the banks to rate them, not by the investors who were buying them. And suddenly the risk that was being created in suburban American neighborhoods was being distributed to pension funds in Norway, to insurance companies in Germany, to sovereign wealth funds in Asia, and nobody understood how interconnected the system had become until it all came apart at once. Bear Stearns was the first domino, and JPMorgan, Dimon's own bank, was the one that had to catch it. In March of 2008, Bear Stearns essentially ran out of money overnight because its counterparties stopped trusting it, and the Federal Reserve brokered an emergency deal where JPMorgan acquired Bear Stearns in a matter of days. And if that sounds orderly and controlled, I promise you it wasn't, because there were people in the building on that Sunday night who genuinely believed that if the deal didn't get done by Monday morning, the entire global financial system might collapse. And then 6 months later, in September of 2008, Lehman Brothers filed for bankruptcy, and this time there was no rescue, no emergency acquisition, no white knight, and the shockwaves from Lehman's collapse froze credit markets around the entire world within days. Banks stopped lending to each other because nobody knew who was holding the toxic assets. Money market funds broke the buck, commercial paper markets seized up, and for a period of about 2 weeks, the global financial system came closer to complete cardiac arrest than at any point since the Great Depression. And the human cost, that's the part that gets sanitized in the history books. Millions of families lost their homes, unemployment spiked, retirement savings were slashed, and the people who caused it, the executives who loosened the standards and packaged the garbage and sold it to pension funds, most of them walked away rich, while the rest of the country spent the next decade trying to rebuild what they destroyed. That is what Jamie Dimon is referencing when he says he sees parallels to the pre-crisis era. That is the history he's invoking, and he is not a man who invokes that history lightly. So now the question becomes, what exactly are these dumb things that Dimon sees happening right now? Because he didn't just say rivals are doing dumb things for dramatic effect. He was responding to a specific question about fierce competition across the financial industry, and when you look at what's actually happening in the lending markets right now, the parallels to the mid-2000s are hard to ignore. Let's start with the competitive dynamics, because the banking industry right now is in the middle of one of the most aggressive fights for loan volume that we've seen in years. Banks are hungry, they're desperate for revenue growth, their stock prices depend on showing investors that they can grow their loan books. And when every bank in America is fighting for the same pool of borrowers, the inevitable result is that someone starts cutting corners on credit quality. Someone starts offering terms that are too generous. Someone starts lending to borrowers who shouldn't be getting that much credit. And once one bank does it, the rest have to follow or lose market share. And this isn't just happening in one lending category this time, it's happening across every category simultaneously. In leveraged lending, where banks make loans to highly indebted companies, the standards have been deteriorating for years, with fewer protective covenants, looser terms, and higher leverage ratios than at any point in recent memory. These are called covenant-light loans, and the name tells you everything you need to know because a covenant in a loan agreement is a protection for the lender. It's a tripwire that gives the bank the right to step in if the borrower's financial condition deteriorates, and when you strip those covenants out, you're essentially lending money with no safety net. You're trusting that the borrower will pay you back because they promised to, not because you have any legal mechanism to force them to. In private credit, which has exploded into a massive market over the last several years, the dynamics are even more concerning, because private credit operates largely outside the traditional banking regulatory framework, meaning the same kind of risk that blew up the banks in 2008 is now accumulating in funds and vehicles that don't have the same capital requirements, don't have the same reporting standards, and don't have the same regulatory oversight, and yet they're making the same kinds of loans to the same kinds of borrowers that the banks used to serve before the post-2008 regulations made it too expensive for banks to hold those risks. And here's the thing that really keeps me up at night. It's not just one sector, it's everywhere. Commercial real estate lending is under enormous pressure because office buildings are still half empty, and the loans that were made at pre-pandemic valuations are coming due, and the buildings are worth a fraction of what they were when the loans were originated. And instead of recognizing the losses and forcing borrowers to put up more equity, many lenders are choosing to extend and pretend, rolling the loans over and hoping that somehow the market recovers before they have to admit the money is gone. Auto loans have been stretching to longer and longer terms, with some borrowers now taking out 84-month loans on depreciating assets, meaning they're underwater on their car loan for years. Credit card debt has been climbing steadily, and delinquency rates have been ticking up across the board. And through all of this, banks are competing more aggressively for the loans that are still available, which means they're offering better terms, lower rates, fewer protections, exactly the kind of behavior that Dimon is warning about. And the parallels to the pre-2008 era are structural, not just cosmetic. In 2005, 2006 and 2007, the banks that were doing the dumbest things were also the ones reporting the best earnings, because bad lending looks like great business right up until the moment the defaults start. And the defaults always start 2 to 3 years after the loans are made, which means we could be sitting right now in the sweet spot where the dumb things look like smart things, and nobody wants to listen to the guy at JPMorgan telling them that the music is about to stop. Now let's talk about JPMorgan itself, because JPMorgan's behavior right now is telling you something far more important than anything Dimon said with his words, because actions speak louder than words, and what JPMorgan is doing with its actual lending practices is the equivalent of a 5-alarm fire warning that nobody wants to acknowledge. JPMorgan is maintaining conservative lending practices, and that phrase sounds boring. It sounds like corporate boilerplate. But in the context of what's happening in the industry, it's actually extraordinary, because it means JPMorgan is voluntarily leaving money on the table. It means they're watching their competitors steal clients and win deals and grow their loan books faster, and they're choosing not to compete. And when the most sophisticated, best-resourced, most data-rich bank in the world looks at the terms being offered in the market and says we're not going to match that, you need to ask yourself why. And the answer is simple. JPMorgan's risk models are telling them that the loans their competitors are making are going to blow up. There is no other explanation for a bank to voluntarily cede market share in a competitive environment unless they believe the risk doesn't justify the return. And Dimon has been through this exact movie before. He's the one who stayed disciplined in 2006 and 2007 when Countrywide and Bear Stearns and Washington Mutual were writing mortgages to anyone with a pulse. And when the system collapsed, JPMorgan was the only major bank healthy enough to acquire the wreckage. JPMorgan's stock dropping 4.21% in response to Dimon's comments is itself a data point that most people are reading wrong. The conventional interpretation is that the stock fell because Dimon said something scary, but that's actually backwards. The stock fell because the market recognized that if Dimon is right, if the dumb things his competitors are doing eventually blow up, then the entire banking sector is going to take a hit, and even JPMorgan, even the disciplined one, even the one that didn't do the dumb things, is going to feel the pain. Because banking is an interconnected system, and when one major institution fails, it creates contagion that spreads to everyone. That's what happened in 2008, and that's what Dimon is telling you could happen again. JPMorgan didn't make the bad loans that blew up the system in 2008, but JPMorgan's stock still fell dramatically from its pre-crisis peak because when credit markets seize up, when counterparties fail, when trust evaporates, everyone suffers, and the damage doesn't discriminate between the careful and the reckless, at least not in the short term. So when you see JPMorgan's stock at $297.67, down from $310.76, don't think of it as just a normal market fluctuation. Think of it as the market's way of saying, we heard what Dimon said, and we're starting to price in the hour to automate and speed up the exact lending processes that need more human judgment, not less. Banks are using machine learning models to underwrite loans faster, to approve borrowers faster, to process applications at scale and on the surface that sounds like progress, that sounds like efficiency. But what it actually means is that the guardrails are being removed even faster than they were in the mid-2000s. In 2005, when a bank wanted to loosen its credit standards, it had to physically change its underwriting guidelines, retrain its loan officers, update its policy manuals, and the process took months, which meant there was time for risk managers to push back, time for regulators to notice, time for the implications to be understood before the damage was done. But with AI-driven underwriting, a bank can adjust its risk tolerance with a few parameter changes in a model, and suddenly millions of dollars in new loans are being originated to borrowers who wouldn't have qualified yesterday, and nobody had to sign off on it because the algorithm made the decision. And the competitive pressure that AI creates is multiplicative, not additive. Because if one bank deploys an AI system that can underwrite loans in 15 minutes instead of 15 days, every other bank in the industry has to match that speed or lose every single deal to the faster competitor. And speed in lending is the natural enemy of quality, because due diligence takes time, verification takes time, understanding a borrower's actual ability to repay takes time, and when you compress that process from weeks to minutes, you are by definition cutting corners. You are by definition accepting more risk. You are by definition doing the dumb things that Dimon is warning about. And this is the cruel irony of AI in banking, the same technology that JPMorgan is using to better assess and manage risk is possibility that he's right, that the competition-driven loosening of credit standards across the banking industry is creating a problem that's going to catch up with everyone, including the bank that saw it coming. And this is the pattern that repeats every single time the whistleblower gets punished by the market for being honest, while the reckless competitors get rewarded for their aggression. Right up until the moment the defaults start cascading and then suddenly the market remembers who was right. But by then the damage is already done, and it's your retirement fund, your savings account, your home equity that absorbs the shock. Now there's a second piece of what Dimon said at this investor event that's gotten almost no coverage, and it's the part about artificial intelligence, because Dimon specifically addressed navigating the era of AI in the financial industry, and this connects to the lending problem in a way that is genuinely chilling. If you think about it for more than 5 seconds, here's the connection that nobody is making. The rush to deploy AI across the financial industry is accelerating every single one of the competitive dynamics that Dimon is warning about. Because AI is being used right and being used by its competitors to take on more risk faster. And the regulators are years behind in understanding how these models work, which means the industry is essentially self-regulating its use of AI in lending. And we all know how well self-regulation worked out the last time the banking industry was left to police itself. Dimon knows this, which is why he brought up AI in the same speech where he warned about rivals doing dumb things. Because in his mind, they're connected, the technological acceleration is amplifying the competitive dynamics that lead to the loosening of standards, that lead to the build-up of risk, that lead to the kind of crisis he's seen before. And the speed at which it's happening this time is faster than anything the industry has ever experienced. Let me tell you something about financial crises that most people don't understand, and this is the thing that really gets me fired up, because it's so obvious, and yet the industry keeps repeating the same pattern over and over again. Every major financial crisis in the last century has been preceded by a period where smart people issued warnings, and those warnings were ignored, dismissed, or actively suppressed, because the people who were making money from the reckless behavior had no incentive to listen, and every incentive to silence the critics. In 2005, there was a woman named Sheila Bear at the Federal Deposit Insurance Corporation who started raising alarms about subprime mortgage lending, and she was told she was overreacting. She was told the models were sound. She was told that housing prices don't go down nationally. And 2 years later, the entire system collapsed exactly the way she said it would. In 2006, there were analysts and economists who published research showing that the mortgage market was a ticking time bomb, and they were ridiculed by the same banks that would later require hundreds of billions of dollars in taxpayer bailouts to survive. And now here we are in 2026, and Jamie Dimon, who is not some obscure regulator or contrarian analyst, but the most powerful banker in the world, is standing on a stage and telling investors that he sees the same patterns that preceded the 2008 crisis. And what is the market doing? It's shrugging. The financial media ran his quotes for half a news cycle and moved on. The other bank CEOs haven't responded, the regulators haven't said a word, and the dumb things that Dimon is warning about are continuing to happen, because the loans that are being made today won't go bad for another 2 to 3 years, and in the meantime the banks doing the dumb things are posting great earnings and their stock prices are rising, and everyone thinks they're geniuses. This is the pattern, this is always the pattern, and the fact that we know the pattern and still fall for it every single time should make you furious, because it means the system is not broken, it's working exactly as designed. The incentives reward short-term risk-taking and punish long-term discipline, and the people who bear the cost when it all falls apart are not the CEOs who made the decisions, it's ordinary people, it's your retirement account, it's your mortgage, it's your job, it's your ability to put food on the table. And Dimon knows this too, which is why his warning is so significant, because he's essentially saying that the competitive dynamics in the banking industry have reached a point where even the most disciplined bank in the country can see that the system is heading toward trouble, and he's choosing to say it publicly, on the record, with his name attached. because when the crisis comes, and he clearly believes it will, he wants to be able to point to this moment and say, "I told you, I warned you, I said my rivals were doing dumb things and nobody listened." So what should you actually be watching for? Because if Dimon is right, and we're in the early to middle stages of a credit cycle that's going to end badly, there are specific indicators that will start flashing red before the crisis hits. And if you know what to look for, you can see it coming months before the headlines catch up. The first thing to watch is credit spreads, which are the difference between the interest rate on corporate bonds and the risk-free rate on government bonds, because when credit spreads are tight, it means the market is pricing in very low risk of default. And when they start widening, it means the market is getting nervous about borrowers' ability to repay. And right now, credit spreads are remarkably tight, given what Dimon is telling us about the quality of lending, which either means the market is right and Dimon is wrong, or the market hasn't caught up to what Dimon is seeing, and history strongly suggests it's the latter. The second thing to watch is bank earnings calls over the next 2 to 3 quarters, because the first sign of trouble in the lending market always shows up in the provision for credit losses line. Where banks set aside money to cover loans they expect to go bad, and if you start seeing provisions tick up across the industry, it means the loans that were made under the loosened standards are starting to show stress. The third thing to watch is the commercial real estate market, because this is where the largest concentration of extend and pretend lending is happening. And when those extended loans finally come due and can't be refinanced at current valuations, the losses are going to cascade through the banking system in ways that will remind everyone of 2008. And the fourth thing to watch is Jamie Dimon himself, because if his warnings get more specific, more urgent, more detailed over the coming quarters, it means the dumb things are getting dumber, and the timeline to consequences is getting shorter. So let's get to the part that matters most. What does all of this mean for you, for your money, for your financial safety? Because it's easy to listen to a breakdown like this and think that it's all theoretical, that it's about big banks and institutional investors, and it doesn't really affect the average person. And if that's what you're thinking, you couldn't be more wrong, because when the banking system gets reckless and credit standards collapse and the defaults start cascading, it is always the average person who pays the highest price. Here's what you need to understand about your exposure to this risk. If you have money in a savings account, if you have a mortgage, if you have a car loan, if you have a 401k that's invested in the stock market, if you have a pension that holds bank stocks or corporate bonds, you are connected to this system, you are inside the blast radius, and when the dumb things that Dimon is warning about start blowing up, the shockwaves are going to hit you whether you're paying attention or not. In 2008, the average American household lost a devastating share of its net worth, not because they personally did anything wrong, not because they personally made bad financial decisions, but because the banking system that their entire financial life was built on top of collapsed under the weight of reckless lending decisions made by people who never had to face the consequences of those decisions. And if you think the regulatory reforms that were put in place after 2008 prevent that from happening again, I want you to remember that Dimon himself just told you that banks are doing dumb things again, which means either the regulations aren't working or the banks have found ways around them. And either way, the result is the same. Risk is building in the system, and it's your money that's going to absorb the impact when it detonates. And the timing of this warning is what makes it so urgent, because Dimon didn't say this 5 years ago, when it was a theoretical possibility. He didn't say it last year when it was a concerning trend. He said it this week, on February 23rd, 2026, at an investor event, in response to a direct question about competition, which means the behavior he's describing isn't something he's worried might happen in the future. It's something that's happening right now, today, in real time, And the loans that are being made under these loosened standards are going on the books right now, creating the losses that will materialize in 2028 or 2029 or 2030. And by the time those losses show up, the window to protect yourself will have closed. I'm not telling you to panic. I'm not telling you to pull all your money out of the bank tomorrow. I'm telling you to pay attention, because the most important financial warning of the year just got issued by the one person in the entire financial system who has the track record and the credibility and the institutional knowledge to know exactly what he's talking about. And if you ignore it, because the stock market is still going up, and your portfolio still looks fine, and the economy hasn't crashed yet, then you are doing exactly what people did in 2006 and 2007. You are trusting the surface while the foundation cracks beneath you. The time to prepare is not when the crisis hits. The time to prepare is now, while the warnings are being issued, while there's still time to reduce your exposure, to strengthen your financial position, to make sure that when the dumb things start blowing up, and they will blow up because they always blow up, you're not the one left holding the bag. And here's the final piece that I want to leave you with, because I think it's the most important thing to understand about what Dimon said. When the CEO of the largest bank in America uses the phrase dumb things to describe what his competitors are doing, he is not being casual. He is not being colourful. He is making a calculated decision to put a warning on the public record. Because Jamie Dimon is many things, but imprecise with his language is not one of them. This man has spent 4 decades in banking. He has navigated more crises than most people can name. He was the one who picked up the phone when the government called about Bear Stearns. He was the one who had to figure out how to absorb a failing institution over a single weekend in March of 2008. And when a man with that experience, that track record, that vantage point, looks at the current competitive landscape and sees parallels to the era that nearly destroyed the global financial system, you don't dismiss it as one man's opinion. You don't bury it on page 6 of the business section. You sit up and you pay attention, because history has a very ugly way of rewarding the people who ignored these warnings with devastating consequences they never saw coming. The question is not whether Dimon is right about his competitors doing dumb things. The question is how bad the dumb things have already gotten, and how long we have before the consequences show up. And the answer to that question depends on whether the industry is in the early stages of loosening credit standards the way it was in 2004, or the late stages the way it was in 2007. And the fact that Dimon felt the need to say something publicly right now suggests we're further along this curve than most people want to believe. I'm going to be following this story very closely, because what happens next in the banking industry over the next 12 to 18 months is going to determine whether Dimon's warning was premature or prophetic. And either way, you need to be paying attention, because your financial future depends on understanding what's happening inside the institutions that hold your money. And right now, the one institution that understands it better than anyone else is telling you to be worried. If you're not subscribed, fix that right now, because I'm going to be tracking every single data point that confirms or denies what Dimon just warned us about. And trust me, next week there's more coming.